There's one number that every hedge fund manager, every pension fund director, and every Wall Street analyst was staring at on Tuesday morning. Not the missile count, not the casualty numbers, not the diplomatic cables. One number, the VIX, the volatility index. Wall Street's fear gauge, the single most precise, real-time measurement of how uncertain professional investors believe the next 30 days are going to be. And on Tuesday, March 3rd, 2026, the VIX hit levels last seen during the darkest moments of recent financial history. And here's the part. Nobody on mainstream TV is telling you clearly enough. This is not a geopolitical event anymore. This is an economic event, and it is heading straight for your grocery bill, your gas pump, your mortgage rate, and your retirement account. Stay with me for the next 15 minutes, because what I'm about to explain is going to change how you see every financial headline for the next several weeks. On the weekend of February 28th, the United States and Israel launched coordinated military strikes on Iran. These weren't surgical strikes on a single nuclear facility. According to reporting from CNN, Investing.com, and multiple financial research houses, the strikes targeted every layer of Iranian state power simultaneously. Political leadership in Tehran, nuclear facilities, missile production systems, IRGC infrastructure, ports, oil assets, airports, and military bases stretching from west to south. The objective was total degradation, not one facility, everything at once, Iran responded. Hundreds of missiles and drones were fired at the UAE and Kuwait. Attacks hit the Gulf. Iran announced the conditional closure of the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's daily oil supply travels. And then President Trump, in a New York Post interview, said something that changed everything. He said the war could last 4 to 5 weeks, with the capability to go far longer than that. That sentence did more financial damage than any missile, because here's what Wall Street heard when Trump said 4 to 5 weeks. They heard, the playbook is broken. Every major institutional investor has a playbook for geopolitical events. Wars happen. Markets absorb them. The playbook says, sell cruise ships and airlines, buy defense stocks and energy, hold the tech majors, wait for clarity. The playbook has worked for decades because wars typically don't last long enough to materially damage corporate profits. The assumption built into every risk model on Wall Street is that oil supply disruptions resolve within weeks. America wins, markets rebound. On Monday, March 2nd, the playbook was still working. Yes, oil spiked. Yes, some airlines dropped. But the S&P 500 and the NASDAQ actually turned positive by the close. The Dow only lost 73 points. Professional money said, manageable, temporary, priced in. Then came Tuesday. On Tuesday, March 3rd, the MSCI World Index, the broadest measure of global stock market performance, covering 23 developed countries and approximately $60 trillion in market capitalization, posted its worst single day since June 2025. Not its worst day since Saturday's strikes, not its worst day since Monday. Its worst day since the previous war ended. Think about what that means. 5 days into a brand new war, Tuesday produced worse global financial damage than any single day of the first 5 days of the conflict. Why Tuesday? Because on Tuesday morning, the data arrived all at once. 3 American soldiers dead, 5 seriously wounded, a THAAD missile defense battery destroyed. Secretary of State Rubio acknowledged on the record that America produces 6 interceptor missiles per month against Iran's capacity to fire hundreds. Ras Tanura, Saudi Arabia's largest refinery, shut down after being bombed. Qatar, which supplies 20% of the world's liquefied natural gas, halted operations entirely after its facilities were struck. The U.S. Embassy in Riyadh caught fire. The playbook stopped working. Japan's Nikkei down 3.0%, China's CSI 300 down 1.5%, Germany's DAX down 4.2%, London's FTSE All-Share down 3.3%, New York's S&P 500 down 2.2%, MSCI World Index down 2.7%. Every major equity market on Earth, simultaneously, in a single trading day. Tokyo, Shanghai, Frankfurt, London, New York, all down, all in the same session, all for the same reason. But the number that stopped me cold was South Korea. South Korea's benchmark stock index, the KOSPI, dropped 452 points, a 7.24% single session collapse. That wiped out roughly $270 billion in market value. Foreign investors dumped more than $3 billion in local stocks. The Korean won slid to its weakest level in nearly a month. This was South Korea's worst single day in 19 months. Its worst session since the August 2024 yen carry trade meltdown, $270 billion. Gone. From one country in one day. Why South Korea? Because South Korea runs a massive trade surplus in semiconductors, the chips inside your phone, your laptop, your car. And South Korea imports virtually all of its energy. And a critical share of that energy moves through the Strait of Hormuz, the same strait that Iran just conditionally closed. Now here is where it gets really important and really personal for American investors. Gold fell 5% Gold, the ultimate safe haven, the asset that every institutional investor on the planet moves into when everything else is on fire. Gold fell 5% to around $5,410 per ounce. Silver futures fell more than 8%. Gold miners collapsed. Hecla mining down 15%. Kerr mining down 13%. Hochschild mining down 17%. In every previous geopolitical crisis of the past 50 years, every war, every market crash, every moment of institutional panic, gold went up. Not always by a lot, not always for long, but up. Because gold is what institutions buy when they don't trust anything else. On Tuesday, March 3rd, gold fell while everything else fell simultaneously. That is not the safe haven trade working. That is the safe haven trade breaking down. When gold doesn't go up during a crisis, it means institutions are not running to safety. They are running to cash, specifically US dollars. The dollar rose 1.1% on its DXY index, the sharpest single-day gain since last May. And simultaneously, bond markets sold off around the world. Sovereign debt posted losses. U.S. Treasury yields, which move opposite to bond prices, jumped. The 10-year Treasury yield saw its biggest single-day advance since October. Dollar up, bonds down, gold down, stocks down. Every single asset class declining at the same time, except the dollar. This combination has a specific name in financial markets. It is called a deleveraging event, not a geopolitical sell-off, not a war premium being priced into energy. A deleveraging, the forced sale of assets across every category by institutions that need to raise cash because their risk models have stopped functioning. Their margin calls are arriving faster than their liquidity can cover them. JP Morgan, the largest bank in America, published a note to its institutional clients on Tuesday. Sovereign wealth funds, pension funds, hedge funds, the people who manage more money than the GDP of most countries on Earth. JP Morgan told them, this war carries greater macroeconomic risk than any recent comparable conflict. Greater than the U.S. intervention in Venezuela, greater than the June 2025 Iran-Israel war. That assessment, landing in every institutional inbox simultaneously, is what drove Tuesday's global sell-off. Not the missile counts, not the casualty figures. JP Morgan's risk assessment oil prices surged as much as 13% from their Sunday evening open before partially recovering. By Tuesday, Brent crude was touching $84 a barrel. West Texas Intermediate crossed $76. European natural gas, TTF, added another 27.8% on Tuesday on top of Monday's 39% gain. In 2 trading days, European natural gas nearly doubled. ING Research, in a note distributed to every professional bond trader in every major financial center on Tuesday morning, asked the question that now determines everything: whether Iran can escalate its attacks on the production facilities of the region's key marginal energy suppliers. The key marginal suppliers. Not Ras Laffan, already shut. Not Ras Tanura, already hit. The facilities that have not yet been struck. Abqaiq, the Saudi processing facility that handles roughly 7% of global oil supply in a single installation. Khawar, the world's largest conventional oil field. The offshore platforms in Abu Dhabi's ADNOC complex. The Kuwaiti export terminals at Mina Al Ahmadi, whose capacity feeds refineries across Asia that have no alternative source. If any one of those facilities is disrupted, not destroyed, just disrupted, Wood Mackenzie's analysts told clients oil does not stop at $100. $100 per barrel. That is the threshold. Because above $100, every airline's fuel costs explode, every shipping company's costs explode, every food producer, every chemical manufacturer, every company whose products travel by sea, their input costs surge. And those cost increases show up in quarterly earnings reports in April and May. And that is the moment when the stock market's assumption that wars don't materially damage corporate profits gets tested against the actual profit and loss statements of companies that spent March buying jet fuel at a 60% premium. Energy costs embed in input prices. Input prices appear in consumer prices. Consumer prices trigger wage demands. Wage demands force central banks to keep interest rates higher for longer. Higher rates depress valuations across every asset class. And the 2026 rally, the one that took the Kospi to 6,147, gold to $5,300, the S&P 500 to $6,900, starts reversing in ways that no single headline can reverse. Now here is the critical connection. Trump said the war could last 4 to 5 weeks. His lower estimate of 4 weeks is 28 days. His upper estimate, far longer, has no published endpoint. The Federal Reserve is already in a difficult position. The New York Fed's John Williams said on Tuesday he is in wait-and-see mode. Traders still expect the Fed to hold rates at the current 3.50 to 3.75% target range when it meets this month. The rate cuts that markets spent January and February pricing in, those expectations are now in serious doubt. Because the Fed cannot cut rates into a war-driven energy shock without destroying its inflation-fighting credibility. And it cannot raise rates into a slowing global economy without triggering a recession. That is the trap. And it is the trap that connects a conflict in the Gulf to your mortgage rate, your car loan, your credit card interest, and the cash in your savings account. Wells Fargo mapped out the scenarios. Their base case still targets the S&P 500 at 7,500 by year end. Their worst case, a prolonged Strait of Hormuz closure, sees the S&P dropping towards 6,000. That is a 12 to 13% drop from current levels. Oxford Economics, in their initial analysis of the 2026 Iran war, made the argument that Iran cannot ultimately win militarily. But they were very clear on something else. Disrupting Gulf oil flows could inflict material economic damage and market volatility that outlasts the conflict itself. JP Morgan has raised its gold price target to $6,300 per ounce by December 2026. The defense sector is a clear beneficiary. Boeing, Lockheed Martin, Northrop Grumman, Elbit Systems, all moving higher. Exxon and Chevron gained in pre-market trading as oil companies benefit from elevated crude prices. Airlines are the most obvious casualty. Energy-intensive manufacturers are next. Any company with significant Asian supply chain exposure, because Asia is the region most vulnerable to a sustained Hormuz disruption. But here is the most honest thing I can tell you. Wednesday's calculation, and every day's calculation after that, depends on what Iran fires next, whether those marginal energy suppliers get hit, whether the Strait of Hormuz goes from conditionally closed to effectively closed, whether Trump's 4 weeks becomes 8 weeks. The market is not panicking. The market is calculating. It is calculating 4 to 5 weeks of oil above $80, European gas above 60 euros per megawatt hour, South Korean semiconductors facing energy disruption, global bonds repricing for a higher for longer rate environment, and a Federal Reserve that is boxed in. That calculation produced Tuesday's sell-off, Tuesday, March 3rd, 2026. The MSCI World posted its worst day since June 2025. South Korea lost $270 billion in a single session. Its worst day in 19 months. Gold fell 5%. The safe haven trade broke down. The dollar was the only thing that went up. JP Morgan told its clients this war carries greater macroeconomic risk than any recent comparable conflict. The bond market rally that professional investors spent January and February building was erased in a week. And Trump's 4 to 5 week timeline sits exactly at Wood Mackenzie's 1 month threshold. The boundary where manageable becomes structural. 1 month. That's the number. If this war ends in 28 days or fewer, the damage is real but recoverable. Corporate profits take a hit. Gas prices spike. Bond markets reprice. But the economy absorbs it. If this war extends beyond that boundary, through the entire month of March and into April, the cascade begins. And cascades are very difficult to stop with a ceasefire or a Truth Social post. Watch the Strait of Hormuz. Watch the marginal energy suppliers. Watch the VIX. Watch gold. Not because they'll tell you when the war ends, but because they'll tell you whether the economic damage already done can be undone. If you found this breakdown valuable, share it right now with anyone you know who has money in the market, pays an energy bill, or wonders why their groceries keep getting more expensive. Because this war is not just being fought in the Gulf, it's being fought in your wallet. And unlike the missiles, you can actually see this one coming